Welcome to the deep dive. Today, we're going like behind the scenes of the crypto world, but not in the way you might expect. We're not talking about like the next Bitcoin or the hottest new NFT.
Right.
We're digging into the spectacular collapse of Three Arrows Capital
Yeah.
or 3AC to uncover the crucial lessons of operational due diligence.
That's right. 3AC was once a major player in the crypto hedge fund space, managing billions.
Huge, yeah.
But their story is a cautionary tale, and we're using a case study from the University of Hong Kong to dissect exactly what went wrong.
So this isn't just for crypto enthusiasts, right?
Absolutely not.
Okay.
Whether you're considering investing in a startup, a real estate project, or even just trying to sharpen your analytical skills, this deep dive is for you, because at its core, this is about risk assessment, how to spot red flags and make informed decisions in any investment.
I'm intrigued. So 3AC, where do we even begin?
Let's start with the founders, Suzu and Kyle Davies.
Yep.
They started 3AC back in 2012, initially focused on traditional forex trading. But as crypto gained momentum, they shifted gears and rode that wave to incredible heights.
They were the rock stars of crypto, right? I remember seeing pictures of their lavish lifestyle, the much wow yacht, the mansions.
Exactly. They cultivated this image of success and visionaries, attracting investors and amassing billions under management. But, as we know, that success was short-lived.
2022 was a brutal year for crypto, wasn't it?
It was, and for 3AC, it was the beginning of the end. Their heavy investment in the Luna token, which crashed to near zero, triggered a cascade of losses. And as the dust settled, it became clear that there were much deeper issues at play.
No.
Issues that, with proper operational due diligence, could have been spotted.
Okay, so let's talk about these red flags.
Right.
The case study breaks down 3EC's failure across several key areas of due diligence. Where should we start?
Let's begin with the legal and regulatory landscape. 3AC claimed to be licensed by the Monetary Authority of Singapore, or MAS. But when the MAS investigated, they discovered some discrepancies, to say the least.
What kind of discrepancy?
It turns out 3AC was operating with the wrong type of license for their activities. They were also accused of failing to disclose crucial information about their operations and assets under management.
So they were essentially misrepresenting themselves to regulators.
Yeah.
That's a pretty big red flag right there.
It is. And it highlights a crucial first step in operational due diligence: verifying regulatory compliance.
Right.
Don't just take a company's word for it. Dig into the details and make sure their claims hold up.
Makes sense. You mentioned assets under management. What about their financials more broadly? Were there any red flags there?
There were. Reports indicate that 3AC allegedly inflated their assets under management to attract lenders and investors. Those billions they boasted about.
Yeah.
Well, there's reason to believe those numbers weren't entirely accurate.
Wow. That's bold. I mean, how do you even get away with that? Were there no checks and balances?
That brings us to the next major area of due diligence: governance. 3AC's structure was remarkably opaque. Essentially, Suzu or Kyle Davies had absolute control with no independent board of directors or oversight mechanisms.
So no one to question their decisions or challenge their strategy. It sounds like a recipe for unchecked risk-taking.
Yeah.
Would you invest in a company with that kind of governance structure?
I wouldn't. And this is why understanding a company's governance is so crucial. You want to see checks and balances, transparency, and accountability. Without those, you're essentially betting on blind faith.
Okay, so we've got regulatory compliance and governance. What about their actual operations, the day-to-day running of the business?
This is where things get even more interesting. 3AC was known for its lack of formal policies and procedures, especially in the critical area of trading. Remember, the crypto market operates 24/7 with prices fluctuating constantly.
That sounds chaotic. So they were making billion-dollar decisions on the fly with no clear guidelines.
That's the picture that's emerged, and it speaks to a fundamental principle of operational due diligence, understanding how a company actually functions. You want to see systems in place for risk management, decision-making, and handling large sums of money.
It's like the difference between a seasoned pilot with a flight plan and someone just winging it in the cockpit. No thanks.
Exactly. And when you're talking about billions of dollars in digital assets, there's another layer of complexity: IT and cybersecurity.
That's what I was just thinking. Billions of dollars in digital wallets. What kind of security measures did 3AC have in place?
That's the concerning part. Reports suggest a startling lack of controls. Large transfers of funds were made without adequate safeguards, making them vulnerable to hackers and internal breaches.
It's like leaving a vault full of cash unlocked. You're practically inviting trouble.
It highlights the critical importance of cybersecurity in the digital age. especially for companies dealing with large sums of money.
So we've covered legal and regulatory compliance, financials, governance operations, and cybersecurity. What's left?
Perhaps the most crucial area of all, risk management.
Mhm.
And this is where 3AC's story takes a truly reckless turn.
In what way?
Their approach to risk was, to put it bluntly, reckless. They had no limits on leverage, meaning they were borrowing heavily to amplify their bets. They concentrated their investments in highly volatile altcoins, and when those bets started to go south instead of cutting their losses, they doubled down.
So they were basically breaking every rule in the risk management playbook.
Pretty much. And it's a classic example of how a lack of discipline and sound risk management can lead to catastrophic consequences.
So the house of cards eventually collapsed and they lost everything.
Yes, their portfolio was decimated and they were forced to file for bankruptcy.
Oh, wow.
But the story doesn't end there.
This is getting juicy.
Mm.
What happened next?
Well, they filed for Chapter 15 bankruptcy, which is specifically designed for cross-border insolvency cases. But what's interesting is that they also tried to claim creditor status themselves, attempting to recoup some of their losses.
Wait, so they were trying to get paid back after their company went bankrupt?
Exactly. And on top of that, they initially attempted to dodge authorities, leading to their eventual arrest in Singapore for failing to cooperate with the liquidation process.
So there were legal consequences after all. It sounds like a real mess.
It was a spectacular downfall, and the repercussions are still being felt throughout the crypto industry.
It seems like there's a lot we can learn from this, even if we're not crypto experts.
Absolutely. 3AC's collapse provides a stark reminder that due diligence, especially operational due diligence, is not optional. It's essential.
Okay, so we've uncovered a lot of red flags, but let's shift gears for a moment.
Right.
What does good operational due diligence look like? What are the green flags that should give us confidence in an investment?
That's a great question, and it's just as important as understanding the warning signs. Let's start with transparency. That's a great question, and it's just as important as understanding the warning signs. Let's start with transparency.
Transparency, that makes sense. A company that's open about its operations, financials, and governance is a good sign, right?
Exactly. Transparency builds trust and allows you to make informed decisions. It's a sign that they're not trying to hide anything. For example, look for companies that are willing to share detailed financial statements audited by reputable firms. Not just summary reports, but the nitty-gritty details.
So no more smoke and mirrors.
Yeah.
I want to see the actual numbers.
Mm.
What else? What are green flags should we be on the lookout for?
Another key indicator is a strong track record of compliance. Look for companies that have a history of playing by the rules, working within the regulatory framework, and staying on the right side of the law. A consistent track record suggests a commitment to ethical and responsible business practices.
So no cutting corners or shady dealings.
Yeah.
Just good, clean business practices. And speaking of good practices, what about the people running the show? What kind of leadership should give us confidence?
Look for companies with experienced and ethical leadership. Do they have a proven track record of success in the industry? Do they have a reputation for integrity and sound decision-making? These are crucial factors to consider because leadership sets the tone for the entire organization.
So no more fake it till you make it, entrepreneurs. We want the real deal, the
Yeah.
people who have been there, done that, and learned from their mistakes. And what about the systems and procedures we talked about earlier? What should those look like in a well-run company?
You want to see well-defined systems for every aspect of the business: risk management, decision-making, financial controls, cybersecurity, you name it. These systems should be clearly documented, regularly reviewed, and constantly updated to adapt to the ever-changing landscape.
So no more flying by the seat of their pants or making billion-dollar decisions on a whim. We want to see order structure and a clear plan for managing the business. This is making me think about my own personal finances. Maybe I need to do some operational due diligence on my own spending habits.
That's actually a great idea. These principles can be applied to many areas of life, not just investments. Whether you're managing your personal finances, starting a business, or even just evaluating a potential partnership, understanding risk and conducting your due diligence can save you a lot of headaches down the road.
So we've covered transparency, compliance, leadership, and systems. What else should we be looking for in our quest for the perfect investment?
Pay close attention to the company's culture. Is it a culture of integrity, accountability, and respect? Or is it a culture of greed, recklessness, and cutting corners?
So vibes matter.
That's interesting.
More than you might think. A company's culture can make or break it. You want to invest in companies where the culture aligns with your own values and principles. You can get a sense of a company's culture by looking at how they treat their employees, their customers, and their community.
Okay, culture check. Anything else we should be keeping an eye out for?
Last but not least, consider the company's long-term vision. Do they have a clear plan for the future? Are they adaptable and innovative, able to navigate the ever-changing market dynamics? Are they committed to sustainability and ethical practices? These are all important indicators of a company's long-term viability and potential for success.
So we're not just looking for a quick buck. We're looking for companies that are building something sustainable and meaningful, something we can believe in. Exactly. You want to invest in companies that are not only profitable, but also make a positive impact on the world. Companies that are creating value, not just extracting it.
This has been an incredible crash course in operational due diligence. I feel like I've leveled up my investing knowledge for sure.
That's what we're here for. Remember, knowledge is power, especially in the world of finance. The more you know, the better equipped you'll be to make informed, responsible, and ultimately successful investment decisions.
Okay, so we've gone deep on the red flags and explored the green flags. But let's bring this back to our listener.
Yes, let's make this practical.
Exactly. What can our listener actually do with this information?
Yeah.
What steps can they take to conduct their own operational due diligence?
What can our listener actually do with this information? What steps can they take to conduct their own operational due diligence?
Yeah, it can feel overwhelming to know where to even start.
It's true, but it doesn't have to be a daunting task. Start by asking the right questions. If you're considering an investment, don't be afraid to dig deep. Request detailed financial statements. Look into the backgrounds of the key players. Research their legal and regulatory track record.
So it's all about being proactive and not just taking things at face value.
Exactly. And remember, publicly available information is your friend. Use online resources to research the company, its leadership team, and its industry. Check for news articles, legal filings, and any red flags that might pop up. And don't underestimate the power of networking. Talk to people in the industry, get their insights and perspectives.
Yeah, it's like being a detective piecing together the puzzle to get a complete picture.
That's a great analogy. And just like a good detective, you need to trust your gut. If something feels off, if the numbers don't add up, or if the answers you're getting are vague or evasive, don't ignore those red flags.
So we've talked about the red flags, the green flags, and the steps to take. But let's bring this back to the 3AC case. What's the ultimate takeaway here? What's the one thing our listeners should remember?
I think the biggest lesson from 3AC's collapse is this. Operational due diligence is not just a box to tick. It's a critical process that can make or break your investment. It's about understanding the inner workings of a company, its strengths and weaknesses, its risks and opportunities.
And it's about being an informed investor, not just following the hype or blindly trusting charismatic leaders.
Exactly. Don't be swayed by the flashy marketing or the promises of quick riches. Do your homework, ask the tough questions, and make informed decisions based on solid evidence. Remember, investing always involves risk, but by conducting thorough operational due diligence, you can significantly reduce that risk and increase your chances of success.
So there you have it, folks. A deep dive into the spectacular downfall of Three Arrows Capital and the invaluable lessons we can all learn from their mistakes.
We hope this deep dive has empowered you to be more informed, more discerning, and ultimately more successful investors.
Until next time, stay curious, stay skeptical, and keep diving deep.